What is up, and welcome back to another amazing episode of How to Invest in Commercial Real Estate.
What up?
Let's just get right into it. We just closed on Champions Terrace, the deal in Houston. It's like a $3.8 million deal.
Yeah, one of the smaller ones we've done in a while, open to non-accredited investors.
Yep, we closed that with Mabry Bank. You know, under market leases, light renovation. I think it needs a paint job. It definitely needs parking lot repairs. And then just as the tenants come up for expiration, we'll push those rents up to market, possibly replace those with new tenants and exit in 3 to 5 years. Simple deal.
Yep.
We're actually looking and buying the deal kind of attached to it.
Yeah, right next door.
Yeah, so we reached out to them trying to get that bought. That was
Next acquisition for us then is in Reno.
we found a lot of deferred maintenance, a lot of issues. So we went back and made a request to the seller. That came back today.
Seemed like the response was reasonable.
Yeah, I would say so.
So I'm optimistic on that one.
Due diligence expires at the end of this week. We'll get that closed in a month. I think we've got $1 million left to raise on that. I haven't really launched it out yet. If you've got interest, definitely reach out to us. We can get you plugged in. If not, make sure you're subscribed to the investor list, and you'll see it when it launches here shortly, any day, if it hasn't already. Outside of that, we have quarterly reports going out. I don't know. We're doing the final draft review tomorrow. So they could go out after that. They could go out maybe Monday. Yeah. We spent a lot more time going over each and every single property, giving a review of 2025 cash flow, a forecast of 2026 cash flow based on the budget, and then a lot of qualitative information about, specific tenants, leases, renovations, et cetera, et cetera. But I think you'll find, if you're getting these updates, if you're invested on one of these deals, that it's more thorough.
Yeah, I agree. I think we owed it to the investors to give out more information and forecast. We owed it to ourselves a little bit, and so I think they'll really enjoy these new updates. So we spent a lot of time on them. I know Braden has.
Yeah, we all have. I mean, they've touched almost every department in the company so far, just circulating and adding more information. And I think it's good because the feedback we're getting is, hey, we want kind of a real-time value every single quarter, which is easy to do. So we spent the legwork in getting the system set up. And now that we've got it set up, it should be very easy to update these values and bases quarter after quarter to get these updates out more efficiently.
Yeah. The main reason we want to do that is that we don't want our investors to run into surprises. So, we had a miss on a development deal last year, and we didn't give enough information about the current status of that. And so I think investors were negatively surprised, and we don't want that to happen again. So now we're putting in the effort and making sure that if we know any negative information, they know it. And positive information, they know it. That way our investors can appropriately plan how many new investments they want to get into. They can also look forward to potential exits if we know when those are going to be. So it's just about transparency. And I think it'll be a good thing.
Also, we're capitalizing an annual budget based on what we think the market cap rate to be. So these values really shouldn't change quarter by quarter. A lot of these are going to get updated annually when you really think about it. We were kind of supposed to have an update from ICSC. The guys are still on the planes traveling back, so we didn't quite get that update. We'll have to plug that in next week. Yep. But yeah, ICSC was in San Antonio. I know Jackson and Andy were down there. I'm jam-packed with a ton of meetings. We've got feedback on several of the deals we have listed. Interested
like
parties.
Good show.
Yeah, it did.
Yeah,
it did. It's normally in Dallas, and this year it's in San Antonio. So whenever they switch it up like that, they tend to get a bit more attendance. Yeah, so we're going to do a fun segment called Deal or No Deal.
What I did was I sent you guys 2 deals. Let's play a little good cop, bad cop, and one of you point out the positives and one of you point out the negatives, and then sell me on whether you do or don't want to do the deal, and then I'll choose a winner.
Yeah, I think the reason we thought about doing this segment is because we have these debates internally every single week where we can talk ourselves into deals or we can talk ourselves out of deals. And there's always going to be pros and cons. There's always going to be positives and then risks associated with those. So that's kind of what we're trying to do here is just give you a flavor for how you should go about evaluating deals. And it's never all positive and it's never all negative, and to keep an open mind when you're evaluating. So that's what we're doing.
Sometimes it's all negative.
Well, I mean, we don't look at those deals too long.
Okay, so let's start on the one in Duncanville, Texas first, which is south of Dallas, suburb of Dallas.
I think I said I would take the positive position on this.
Okay.
And so I'll just start talking about a couple of positives while Braden's getting his bearings there. First of all, it's a suburb of Dallas Fort Worth, and so for me, that's a positive. You've got about 250,000 people within a 5-mile radius, which is really good. You know, I also like household income is not quite as good, but it's not terrible. And what I like about this is that it's got a bunch of built-in rent escalations, and I feel like rents are relatively low. So there's my start, Braden. What do you got?
We might point out, okay, this is about 111,000 square feet.
I mean, first of all, let's put up the picture of this bad boy. Just wow. I mean, whoever designed this needs physically slapped.
Well, it's 7 different properties. It's interesting, all kind of on the same.
It's a lot.
Yeah, it's a lot.
It's a lot.
This looks like a hospital where they built one, then they built another, then they just built something else on. I'll admit that.
So like, it just looks weird. You know, you've got a lot of parking lot exposure. Holy cow! You've got some acreage of asphalt. That is a lot to take care of, ladies and gentlemen.
But on the left side there, you do have out parcel potential.
You do. I wonder about the age of the roof. You got 111,000 square feet. Ollie's is typically a gross lease, so I wonder if you've immediately walking into slippage there. It looked like there was a gas station on the corner. You know, do we have clean phase 1? Did they get the tanks removed? Is it environmentally up to
Firestone Auto? It's not. I don't think it's a gas station. It's Firestone Auto Service though.
The Ollie's is they say retail net, so it's not triple net, but some version of net. A positive for me is that the asking cap rate is 8.25. So I would like to think you might get this in the upper 8s to a 9 cap. So once again, in DFW, if you're getting a 9 cap deal with some national tenants, it could be positive.
Since this is kind of already parceled out in 7 different buildings, could you, if you're buying it, like you say, Joel, for a 9 cap, could you sell some of these out parcels for less than that, for a lower cap rate?
Yeah, I'm sure you could. Ollie's is locked up for another 15 years. So, I mean, you can't really do anything with that.
Yeah, Braden, you are correct. I don't love the layout of this center, but what I do like is on the backside here, you've got the BPL Plasma, which is a decently large square footage, and those tend to be pretty sticky tenants.
And you've got good increases on there, too. So I don't hate that. I know I'm supposed to in this, but I don't hate that.
You know, you've got a Firestone, Advanced Auto Parts, out parcels. So, yeah, I definitely would try to spin those off. And if you look at the rent roll, they do have a lot of yearly increases. And when I look at some of the rents,
I'm asking myself why we haven't seen this in our meetings.
Yeah.
First of all,
like the BPL Plasma is only at $10 yearly increases. Then you got Jiu-Jitsu at $10. You've got Helping Hands of Duncanville at $8. Advanced Auto Parts, they're an out parcel, and so they're a little higher at 16. But you know, most of these rents are in the mid to low teens, and so I think that's fairly positive. Ollie's is at 6, which is great. It's low. Yeah, I do ask that question. Why haven't we seen this? If you could pick this deal up with as much potential leasing momentum and increases,
clip it. Tag Andy. Tag the guys. Guys, why have we not seen this? We should have seen it.
Braden, you want to give me one last attempt at talking me out of this one? I take that as a no. So
I mean,
I'm going to have to declare Joel the winner.
Oh, this is payback. This is payback for last time.
There's no payback here.
Yeah.
This is
rerun the tapes. We know. Tapes don't lie, guys.
All right, let's go to the second one.
All right.
In Memphis, Tennessee.
Listed at an 8.25 cap. I know I'm supposed to be the devil's advocate here, but I would look at this deal. I think it's priced competitively. I think you've got out parcel separation potential.
I thought too.
And you just wait over the few years to reset some of these leases to market, spend some money on the exterior. I don't hate it.
All right. Next one's Memphis, Tennessee. Dollar General Anchored Center. Our friend Jeff Lefkoe is offering this one.
Yeah, I'll let Braden start since he's going to take the positive role on this one.
This one, if you guys see it, why don't you just give us a real quick, how many square feet? Do you see anything like that?
Yeah, 40,000 feet. Looks like it was built in 1972, 3 acres, $5.5 million ask, 7.5 cap on it in place. So this is my favorite deal size. I love the $5 million deal size. You get my favorite suite sizes, which is like 2,000 to 3,000 feet. At most, you have like a Dollar General anchor, which is 9,000 to 11,000 feet typically. I haven't gotten to the rent roll yet, but right off the bat, I like this. I don't hate Memphis. even though I don't know if it's the fastest growing city.
Yeah, I was looking for a map. I mean, this looks pretty well infill located. I've been actually to the French Quarter there in Memphis, and so it's not a terrible area. The big drawback that I would have on this is that it's an asking cap of a 7.5. Mm-hmm. It's an older center, and it's in just an okay market. So that's really the drawback for me is can you get that 7.5 cap up quite a bit? If not, I would have to pass.
I see we've started. Obviously, jeez, I didn't coming in hot with the negatives, my man.
I thought what we were doing.
Right off the bat, I think you look at this thing and you see a well conceptualized design up next to the road. You've got good, clear visibility on all the signs. It doesn't look like you've got any crazy space. The blacktop looks pristine. Tell me it doesn't look like the cleanest parking lot you've ever seen in a sales OM.
The roof doesn't look too bad. It's hard to tell from there, though.
See, Brian's hopping in. He can't even help it. It looks so good.
Well, they did mention a CapEx package that they did in 2025.
I like the exposed brick. Guys, I'm a sucker for unpainted brick. If you paint brick, I'm just kidding. But seriously, don't paint your brick. It looks like garbaggio. Leave it exposed. It's timeless. So average rent of $10.40. Guys, that's nothing. I would say that's 80% less than what we're seeing generally all over the country, mid to high teens. I would think you could get low 20s for this, but I haven't dug too much in. It looks like you've got tons of fast lease expiration, which is good. Again, like roll the tape. Guys, why are we not seeing this? Ayton, Jackson, Andy, my guys, I want to see this.
Yeah, I got to admit I'm supposed to be taking a dump on it, but all the tenants that are not expiring have annual increases that are pretty reasonable. Mm-hmm. And I do agree the rents are low. Dollar General takes up a decent amount of space, but they're only at $8.80, which isn't out of line for them.
On a U.S. highway, it looks like a good retail node there that we may be kind of at the end of. But, I mean, almost across the street is a TJ Maxx, Ross, Chick-fil-A a little down the way.
Brian, why aren't you our acquisitions guy since you found both of these? Because I think they're both worth an offer. Once again, the 7.5 cap's the biggest barrier for me. Yep. But if you could get this to an 8.5,
demos are great, guys. 3 mile population, 79,000.
No. Oh yeah.
Let's go.
What I think I saw 5 mile was 220,000 or something.
This is my type of deal. I mean, it's my deal size. There's no wasted weird
space.
Did
you see the demographics?
Is it income shit?
No. 3 mile radius, 105,000.
Yeah, that's huge, guys.
So
we should buy this. If you're listening right now and we haven't locked it up in contract, you should do it. You should do it. That's why these games are fun.
But lock it up at 8.5, not 7.5.
Yeah. All right.
You've got a good broker, so you better bring your negotiating A game. You've got a McDonald's almost across the street.
Yeah, we know him better than you, so we're going to get.
There's no wasted parking lot. The roof is tight. I mean, this is efficient planning and building, right? Like this person knew what they were doing. We don't have any like crazy 2-story resale. Let's put
it's pretty clean on the build, and it's good frontage. It's got 25,000 cars. I wish I could take a bigger dump on it, but really all I got is the age and the cap rate. That's it.
Okay,
I got nothing else.
Let's see what Dollar General's rent is. $880, and
yeah.
they expire in 19, and they have a 10% bump in their option. They expire in 29, sorry, and a 10% bump, and they'll probably forget to exercise their option. Guys, we're buying this. We're buying it.
All right.
Wait, I'm going to come back.
Declare Braden the winner.
Are we going to have it under contract before the next show?
If we don't, somebody else is going to make tons of money, and that's still going to make me happy. As long as you're one of our listeners, it would make me happy.
All right, so I guess deal or no deal, we decided that we should probably pursue both on some level.
Yeah.
All right, way to go, Brian. You should look more deals up.
All right. I'm on it.
Yeah, for real. Brian's going to work himself into a job real quick.
All right, Braden, what's the main topic for today? Jump right in.
Yeah. So, we never really come up with titles with these things, guys. It's not like we back into a title and then like, oh, how do we form a show around a title? The title's the last thing to go. I don't even know if we come up with the title.
We did come up with a title.
Maximizing rent growth. I mean, it's lame.
Okay. Okay.
But that's what we're talking about.
Exactly. How to maximize your rent growth. So I think just breaking it down real simple before you get into some of the data, guys, we came prepared. All that. I got pages.
Yeah, if you're listening, he's got literally only 2 pages.
There's 2.5. Small type. You're just hateful today. Anyway, why most people don't buy deals is because they have crappy underwriting. Quote me. You don't buy deals because you can't possibly fathom how you could get an NOI big enough to get a sales price big enough to where you make money on a deal. At the end of the day, that's like the fundamental flaw in modeling. You never buy a deal and are just okay with the rent where it's at, right? Inflation is going to work. You've got to assume the NOI or the rent before that NOI is growing. Right. And then you're typically selling on the same market cap rate typically. I mean, you're typically not wanting to assume a crazy amount of cap rate compression or expansion. I mean, just generally same as what you bought it on is a pretty good assumption. So you end up selling for more money not because your market cap rate changed, we just discussed that, but because your NOI is bigger. So your NOI gets bigger because you charge more money in rent. You charge more triple nets. You capture whatever it is, right? More fees associated with the property. And you can increase that rent in your model based on what you think is possible. So at the end of the day, people will think not a lot is possible. They'll be very modest, right? Because they don't want to make a mistake. They're buying a property that's $5, $10, $15, $50 million. You don't want to just throw a number in there. You got to be precise. So in an effort of modesty, they don't underwrite a big enough assumption at the end of the day. And because of that, they can't get to a big enough sales price because they have no rent growth. So then they don't buy the deal because they're like, oh man, I can't make money.
So what are you saying? That they should do some investigation first to see what the local market is for rents, or they should assume that they can do better than that, or there's going to be inflation? What are you saying?
At first, I'm just saying that the only way to buy deals is to believe you can grow the rents.
Right. Okay.
Especially in this market. Especially in this market.
So you have to make some assumption on that in your underwriting.
You have to make an assumption. Okay. So you're probably not buying the deal because you're assuming you can't grow it enough, and you're not arming yourself with enough data. How we are able to buy deals is, first of all, like Joel said, the NOI grows. It is what it is. And we're able to underwrite that ridiculous growth because of the previous data that we have as a company, coupled with our ability to get market data, right? So I think there's two distinguishing factors in that. And we're going to share our data. We're going to go through it all. We're going to give it away for free. We're such nice guys. Market data, anybody can get, right? Like anybody can go on CoStar, LoopNet, Crexi, and see what vacancies are in the market, what they're being asked for, what free lease data you can get off CoStar as far as what tenants are paying, what amount of money, previous sales OMs with rent roll data. Anybody can go and get that. You should get that on every single deal. What we are able to do in addition to that is go through and look at our portfolio of lease renewals, go through and look at our portfolio of similar tenants, similar trades. You know, we have half a dozen Dollar Tree, Dollar General, like it's generally the same stuff. So you can go and look at that data. And it's fascinating, the rent growth that we've achieved in the past 2 years. It's astounding.
Yeah, I was amazed.
And we're doing it. We're doing it. And it's like, no. Yes. Actually, yes. Mm-hmm. And the average is huge, which means the home runs were out of this park. And like the downside is 4%. Which, I mean, let's be honest, that's what most people are building into the model, 4%. If people could achieve these numbers, they would not only be buying deals, but the upside they would be getting from buying those deals would be huge. They'd be making tons of money.
Yeah, so I think when people look at deals on the market, they're probably coming up with a bunch of IRR numbers that just aren't exciting. You know, if you're not going to, underwrite big rent growth or know where the value add is, and you look at a, 7.5 cap deal, you get your debt at 6 or 6.25, you might be lucky to get a 10% IRR. And if you're okay with that, well, then you don't need our advice on rent growth or anything else, because you're going to buy deals and make your 10% and be happy with it.
If you're okay with that, turn the show off now. Turn it off, click exit. You're kicked out. Don't listen. You're blocked.
Yeah, but for us, we're trying to beat the market. We're trying to beat the S&P. We're trying to beat the Dow, and also we want to deliver above average returns to our investors, and also take a cut for ourselves. So we have to really be able to find kind of diamonds in the rough where we can do something outside of the market norms, and that's what we're talking about here. Is we're looking for deals where there is drastic upside in the rents. Now, let's say we don't go in with a deal that if I can't raise these rents, we don't make any money. We're going in, we're going to make decent money if we don't meet all of our rent growth assumptions, but where we really can deliver value.
Make what the other people are okay with, 10 or 11%.
So there still is a buffer on the downside of making 10, 12% IRR, but we're trying to hit 20 or 18. And so that's where being able to have the courage to say, hey, we can grow this rent. This rent is $4. and they're expiring in 2 years, and we know we can double that to $8, given the size, given the location. That's where a lot of money can really be made.
Yeah. This is our data. Let me go over the assumptions really quick. It is from the expiring tenant. It is the difference between their expiring rent and the rent the very next month, right? So a lot of times that first year, they're getting a break, right? They're getting jacked up even more the subsequent years. But we're just taking the percentage between their expiring rent and their new rent. And we're not taking into consideration tenants that didn't renew and we backfilled with new tenants. I need to get that percentage because I have a feeling that percentage is even higher. Yeah. I really do.
Yeah, and just real quick, we're not saying that these numbers are yearly. What we're saying is we get a huge increase when their lease term is up. And then after that big increase, we still then negotiate 3, 4, or 5% annual increases going forward.
An example of that is you acquire the property now, the rent's at 4, you bump it to 8, right? The second time you do that lease renewal, you've already bumped them from 4 to 8. Now you may just do like 4 or 5% annual increases on whatever they're expiring at because you've already done the big.
You got them near market rent. Yeah. Okay.
Okay. So 2025 lease renewal data, we just went over the parameters, 23.71%. 23.71%. When's the last time you underwrote 23.71% rent growth? I mean, it's just. We don't either.
Well, and you're not, obviously, we don't have this number, but we're not doing that property-wide. But we are able to do that with all of the expiring leases that we think are under market. That's what we achieved for those. Now, the other ones may have already had built-in increases, or we were able to get something else. But these are for the expiring leases. We were able to pop them an average of 23%, which is huge.
So I'm going to start just giving some examples. I'll give a brief use. We're not going to give the tenant name. We'll give a rough size and then what expiring and new rent was just for some data points. I think it would be interesting. On the low side, we have like a loan place, like a countertop, maybe a restoration place. Those were 3-6% increases respectively. It looks like you've got a phone store, a restaurant. Those were both at around 7%. I'm going to pick some from the middle of the pack now. We've got too much to list them all. It looks like another restaurant, maybe a loan checking place, had 12-15% increases. We have a nail place that got a 35% increase.
Wow, big.
We got an admin, maybe a check cashing place, got a 40% increase. We got like a mixed martial arts type of use that's got a 40% increase. We've got a postage and shipping use. We have a 75% increase. Again, tons of other examples.
Let me just say this: the cheaper the rents are, and we're buying typically under market rents, the more likely you get a higher percentage. So, like on some of these, we got a 40% increase. You went from $6.50 to $10. Okay, now if you're at $40 to get a 40% increase, we're talking about bumping that almost to $57 a foot. I mean, that's crazy rent. Yeah. So the cheaper you go on the rent, the more opportunity you have on the upside.
Right. And going back to that example we were talking about in Memphis, kind of on the deal or no deal. Here we've got a bunch of small bay shop space tenants with an average rent of $10.40. My renewal offer would be, hey guys, market rent's $20 a foot. Like, what are we doing to get there? How are we getting you there? Do I need to get you a new door? Do I need to get you a new sign? Do you need new flooring in your space? But like, what's the quickest way to double your rent? That's the conversation. Do we settle at 16? Do we settle at 17, 18?
Yeah, maybe.
I'm sure. But guys, compared to 1040, that's a 70 or 80% increase on the rent. That's huge.
Yeah.
Okay, 26 has already been a crazy year, folks. Buckle in. If you include all the data, again, same parameters, what the lease is expiring at to the renewal the preceding month. 2026 year to date, we're at 154%.
That's crazy.
Nice. That's crazy. It's even crazier because there's 2, 4, 6, 8, 10, 12, 14, 16, 18. There's 20 lease renewals already in 2026. And out of those 20 lease renewals, we've averaged 154%.
That's 20 lease renewals in a month and a half.
It's insane.
That's a good pace.
It's insane.
Let's give them a couple of examples.
If you take out the one outlier, which is just, it's nuts. We're still at 70%. There's one outlier that takes it to 154. But if you take that out, we're at 70. So 19 average to 70% increase from what they expired at to what the preceding month was from a lease renewal.
Looking at this list, we've got another good 70 to almost 80 lease renewals to go this year. That's a lot of money.
Well, let's look at some of these. So this is a kind of a cigarette shop, vape shop. They had their own out parcel. They were at 1660. We took them to 2450. That's almost a 47% increase.
Nail salon going from 8 to 17.
100%. Wow. A cell store in Amarillo, $4.67 went to $12.
156%.
It doesn't. Does it give the square footage? It doesn't, but I'm sure that's a relatively small square footage.
I think it's a couple thousand feet, maybe not even that big. A thrift store, we got 28% increase. We just gave an example of a great example of what a thrift store was, and deal or no deal, and what an under market rent is. Going from like something like 8 to what, 11? Is that what it was?
That particular one was 7 to 9.
7 to 9. That's a 28% increase. That's huge. That's huge. We really don't appreciate that. And I know it's $2. You're saying to yourself, oh, it's a $2 increase. Yeah, $2 on like 10,000 feet. It's $20,000 a year. You capitalize that at an 8 cap. That's good money. It's good money.
Another discount store, the big one. We'll kind of touch on, because this is one where they were on a gross lease.
Yep.
And if you back out the triple nets of that gross lease, they were only paying like 50 cents a foot. But they had options. And so there really wasn't anything that we could do to increase that rent. And then we got a gift. Someone screwed up and they sent a cancellation of their lease to us.
Which we accepted.
So which we immediately accepted. Then we received a letter saying that they wanted to rescind said termination of their lease, which we quickly
did not accept.
Yeah. And then what we did was we just took, just plain market data based on other discount retailers that are similar size and similar markets. And we just gave them a new rent of approximately $9. And then they told us how bad their store was doing. And then we're like, we don't care. And then they went ahead and took the $9. So we went from literally 50 cents to $9 on a tenant that we shouldn't have been able to increase the rent at all for at least, 10, 15 years.
Again, there's going to be haters out there. I get it, right? Like, this isn't Grandma Josie or whatever it is in her bookstore that she's owned her entire life, and we're single-handedly ruining her life and putting her out of business. This is a publicly traded company that's just an idiot, right? And we maximized the highest and best value of the center, and we gave them a market rent. We gave them a discount on market rent.
Look at their rent compared to, they have some of the lowest rent in our properties. So we didn't gouge them.
We didn't gouge them. But if you're not going to take advantage of that situation, then you shouldn't be in real estate. They're a publicly traded company, guys. If you're not accepting and maximizing that situation, then you just should not be in this business. That is literally what this business is.
Yeah, what I'm amazed is how bad that landlords are at negotiating rent with tenants. It's kind of like a human trait where we don't want to be uncomfortable. We don't like making other people uncomfortable. We also operate out of fear. We always go, because fear is a bigger driver than reward in our psyche. So we instantly go to, well, they might move out and then I won't have any rent. And that scares me. So I don't want to push. I just want to be comfortable. I'm just going to not increase them, or I'm going to increase them so little. Well, you have to be a better negotiator than that. And you have to actually be more in control of your emotions and not negotiate out of fear. Never negotiate out of fear. We negotiate on metrics and data. And if the data and the metrics tell us that we should increase, then we do it. Now, if you have a bunch of vacancy, you're 50% vacant and you're struggling to get tenants, you may have to, bend over a little bit on negotiations. But if your property's 100% full, that's when you play to win. You negotiate to win.
The publicly traded company that was paying us 50 cents a foot in rent, do you think they felt bad when we bought the center and said, hey, guys, we're not paying anything in rent. Can we pay you more?
Yeah, here, have some more.
No, in fact, they had a small fire, and in their lease, there was some bullshit provision that they got free rent, and we had to fix it because some crazy person went in there and started a fire. Like, hello, why would we be responsible for that? But we covered it, They're exploiting terms in their lease. This is how the business is, right? That's how they operate the business. That's how we operate the business. That's how it is. And I don't know if I said it on the show or it was just plain in the show, but the luxury of getting a discount because you have a cheap basis, because you've been there a long time, is an attribute of a property owner, not somebody who leases property. At the end of the day, falling for a sob story or like, hey, I've been here 20 years. It is what it is, right? You're going to pay market rent at lease expiration. If that's lower, you're going to get a deal. If it's higher, you're going to pay more. That's just, it is what it is. At the end of the day, you're not calling me saying, hey, I really got one over on you. I want to pay you extra rent. No. It's never how these interactions work. Market rent is market rent.
Yep.
It could happen where someone said, hey, I think I'm overpaying. Like when we buy it and they come to us and say, I'll stay if you'll reduce it. I mean, we might consider that as well. So
there's been several examples where people show us financials and we have lowered rent. Yeah. Sure. Like, hey, your business legitimately isn't bringing in that much money. There's been several examples where we disagree or we think, maybe it's a bad use or they're running it wrong and we just put it up for sale and then somebody else can come and pay the higher rent.
If you're going to allow a tenant to negotiate lower rent, you have to get something from them.
Yeah.
And so for us, we may not want to lose that tenant like today. And so, because we don't have a backfill right now, but if I'm going to give them lower rent, I'm also going to get an out. I'm also going to say, hey, I'll lower your rent, but if I find someone that'll pay market rent, then I'm giving you a 60-day notice and you have to move out. Is that a deal? But I'm never giving lower rent without something like that benefits us in the future that I can put a higher paying tenant in there. I'm not signing them up at lower rent for 5 years because they asked for it. Negotiate to win on your leases. Rent growth is how you both buy deals and how you maximize IRR.
If you can't do it, here's a tip. I'm being totally honest. If you can't do it, call me or your favorite broker in the area. It's probably not even me, right? Like
you're not their favorite broker in the area?
Not because of that reason, obviously, but because, we're busy and I don't really do this. But I'm just saying there's leasing brokers out there in every single market that handle lease renewals. It's most likely the new leasing agent. I would be a proponent of doing it yourself because no leasing broker I've ever met in any market that's handling lease renewals would ever suggest a 1,700% lease increase. It's never going to happen. Or a 70% lease increase or a 40% lease increase. They're going to go for like 4. Like, how fast can I get this done where both parties are happy and then I can get my commission check? But at the end of the day, if you can't have these difficult conversations, there's people that will. If you know what rent number you want to get at, if it's 70%, just tell them, tell my tenant 70%. You don't have to be the one physically having these conversations. I think that's maybe a disconnect that people have. And there's people at the end of the day who are ultimately never going to be able to have these conversations. You can hire somebody, you'll pay them 1%, 2%, 3% typically of the total lease value, and they'll have that uncomfortable conversation for you. Okay, well, that is it. And we will see you guys next week on how to invest in commercial real estate.